Okay, so good morning. My name is Jeff Liebig, and I'd like to welcome you to today's webinar. Burt and I talked a lot about this. We wanted to do something for our clients to go through a summary of the Tax Cuts and Job Act in a way that would be able to help focus it on the issues and the changes that we see affecting our individual clients, because so much of this applies to other industries, other sized businesses that are just way outside of our scope. So that being said, welcome. Today is the 20th of January, and Congress is still working on what they call the technical corrections. They've written a lot of this act basically cramming it through very quickly, and in doing so have a lot of conflicting language, so they can't actually implement it the way it's written right now. So over the next several months, we'll see a lot of corrections. What it does is gives us an opportunity to get started analyzing what's there and start formulating some plans, which we'll be working with our clients on after April 15th by the time corrections are done. So all that being said, let's start off by saying the actual tax cuts anticipated under this tax plan are roughly $4.5 trillion. So in order to pass the Senate, the net cost of the tax cuts couldn't be more than $1.5 trillion. So there had to be about $3 million of increased taxes throughout this to net to the $1.5 trillion. So like the old saying goes, there's some winners here and there are some losers. The big question is, which one are you? So we're going to give an overview of the tax reform changes. And while we're not meaning this webinar to actually calculate whether you're going to win or lose, what we're really trying to give you an idea of is the complexity of this Tax Reform Act and give you the opportunity to see if there are any particular areas that are affecting you that we should be aware of. So sit back, grab a big shot of caffeine, because this is not the most exciting stuff in the world, and let's get started. So looking at the individuals, the first thing is the effective date. So let's talk about effective date. Generally speaking, the provisions under this Reform Act start on 12/31 of 17. So really everything's starting in 2018. And it runs out till December 31st of 2025. So for the next roughly 9 years, this is what we will have as the law of the land. Some of the big key components of this. One of the first things, the individual personal exemptions are suspended. In other words, they're gone. So traditionally, we've seen individual exemptions for you, any dependents that you have. Those exemptions are now gone. We had seen them phased out in the past as your income went up, but now they're actually gone. Now in place of that, we have a child tax credit. So this replaces the exceptions that were available before, and now we have an expanded child tax credit of $2,000. So if you have a child under the age of 17, those credits are $2,000. What we're seeing, one of the differences now is, let's say you had a child in college or even an 18-year-old senior in high school. You are usually getting a full exemption for that dependent. Well, now that has changed. So as long as they're under 17, we get this $2,000 credit. If they're over 17, even though they're a high school senior, now you're limited to the $500 dependent credit. The phase-outs are increased, which is good. So in the past, income was substantially lower when you would lose these exemptions. Now we actually don't see those phase-outs until you hit $400,000 for married joint or $200,000 for single. And the other big thing is, moving forward, it's going to require the social security number of the child to be shown on the return. We've been doing that for our clients anyway, but there are those cases where that wasn't applicable. Next big area, capital gain rates, really they're about the same. So we still have the 0, the 15%, the 20% rates, those are all retained. And the 0% rates you can see on this slide, we'll bring this here to the forefront. Really the biggest thing you can see on the slide, The 0% rate applies up to $77,200. For head of household is $51,700, $38,600 for individuals, for singles. The 20% rate applies to anything over $479,000. So once you hit that income level, the rate does max out at 20%. So the next one, adjustments for alimony. This is going to be an interesting one because traditionally, alimony has been paid out and deducted by whoever's paying it out. It's a DAX deduction that went on the front page of the return, and the individual receiving alimony was picking that income up on their individual tax return. Now moving forward for divorce agreements after December 31st of 2018, there will be no more alimony deduction. And correspondingly, there will be no income picked up by the individual receiving the alimony. So this is a big change. And it will certainly require some tax planning when people are going through a divorce, because traditionally we've looked at that big deduction for the individual paying out the alimony. That deduction's not there anymore. So in the essence, there's a lot more out of pocket if you're actually paying the alimony. And on the flip side, if you're receiving alimony, you were picking that up as income, paying income tax on it. Moving forward, you will not be paying any income tax on alimony received. So if you are going to be going through a divorce, this is a key tax planning area that we want to make sure we address.
Hi, I'm Burt Douglass with Douglass and Liebig. I'm going to go over the other tax law changes that affect individuals, primarily standard deductions, itemized deductions. Jeff and I feel that there's some really good tax planning opportunities here. We're going to be reaching out to our clients to start doing some tax planning to make sure that we maximize those benefits. Okay, so one of the big things here is we have the standard deduction change. So the standard deductions starting in 2018 go up to about $12,000 single, $18,000 head of household, $24,000 married filing joint. Remember, when we prepare tax returns, we take the higher of standard deductions or itemized deductions. Itemized deductions are no longer going to be phased out. Remember that many of you were limited on the amount that you could deduct on your itemized deductions because of those phase out. That applies no longer. However, they have either limited or eliminated a lot of your itemized deductions. Keep in mind, our clients that live in California, New Jersey, New York, we have very high state income tax deductions. Those are going to be limited. Okay, so let's review the itemized deductions for state and local taxes. You can take the lower of $10,000 or the total of your state, local, sales, and property taxes. Well, if you live in California, New York, New Jersey, your state income taxes alone could be $20,000. Well, we no longer can deduct 100% of that. There's still some great tax planning opportunities here. We'll be going over with you how to take advantage of that for 2018. Itemized deductions. Okay. Previously, the adjusted gross income limit was 50% on cash contributions. It is now increased to 60%. That does affect some of you. We'll be advising you how to take advantage of that new limitation. However, if you give to your alumni charity donations for college athletic seating to events, those are no longer going to be deductible. Itemized deductions for mortgages. This is a huge difference. It's very complex, but if you get a new loan after December 15th, 2017, you could be facing some limitations on the interest. We no longer can deduct the total amount of your interest. We're now going to be limited on the interest up to $750,000. For those of you that had existing mortgages before that, you will be grandfathered in. One big change, a lot of us have home equity lines of credits. Keep in mind that those are going to be limited, or you are not going to be able to deduct them as we move forward. So just be aware of that. Previously, you could take up to $100,000, pay for your child's education, pay for vacations, pay off other credit card liabilities, and we would be able to deduct the interest. That is going to be suspended as we move forward. Itemized deductions for miscellaneous. Okay, remember we had a separate section under miscellaneous itemized deductions that covered unreimbursed employee business expenses, financial advisor fees, hour fees, union dues, and other miscellaneous deductions. That goes away entirely in 2018. Now, there are a couple of tax planning opportunities for the tax preparation fees. Jeff and I will be meeting with our clients to discuss how we're going to be, how can I say this delicately, recharacterizing a lot of our fees so that they're now going to be deducted through your business. But we'll be discussing that one-on-one with you and share with you our thoughts. There are many changes in the individual alternative minimum tax, or also known as the AMT. A lot of our clients were getting hit with the AMT tax because of the amount of state income taxes that they deducted as an itemized deduction. Remember earlier I said that we're now all limited to a $10,000 maximum tax amount. So most of you who were hit with AMT will no longer be hit with that. So they've changed this considerably. So while they've reduced the AMT tax, they did remove a lot of our state income tax deductions. Education. So remember with those 529 plans, they were only for qualified higher education. Well, they've expanded that for K-12. So now you can expense for K-12 up to $10,000 using your 529 plans. Please talk to us. There are some specific rules and regulations regarding this. So estate tax, I do have good news on this. They did change the rule so it doubles the exemption for the amount to file for estate, gift, and generation skipping tax. Remember, the estate tax limitation was around 5.6 million. They have increased that up to 11,200,000 for each individual. And finally, we have ACA. We're getting a lot of questions what the new tax code is changing on Affordable Care Act. So right now, it does reduce the individual mandate penalty to 0 after December 31st, 2018. However, it does retain that evil and nasty 3.8 tax on net investment income, and that additional 0.9% Medicare tax is being retained as well. Now we're going to be going into the business changes, and we have a separate video on that, so please see our other video on those changes.